Why Media Group? The fastest growing media group in North America.
Welcome to Why Media Newsroom. I'm Ramona Singh, and it's always so great to spend this time with you. For quite some time, we've been talking about Canada's economy and the shrinking factor that we've had essentially 2 quarters of a shrinking GDP, putting Canada in a technical recession. And there was some debate as well that is it really in a recession, since we saw the unemployment numbers change and we saw the job numbers go up. And now today, there seems to be good news as Statistics Canada has released its latest numbers for the month of April. So it looks like Canada's economy has delivered an encouraging surprise to Canadians at a time where it's been so hard. It's been so hard with Trump tariffs. It's been so hard thinking about CUSMA and the renewal on July 1st. What does it mean for Canada's economy? And everything else that has happened. And just the fact that, the headlines for the longest time being that Canada is the only G7 country in a recession, a technical recession. But lo and behold, we had Stats Canada report essentially the economy has expanded 0.5% in the month of April. So that is Q2. We had the bad news for Q4 of 2025 and Q1 of 2026 with a shrinking economy, contracting GDP, and essentially putting us on track of a recession. And now here you have it that Canada's economy has expanded that 0.5 percentage point in Q2, the first month of Q2 being April, and essentially reversing the 0.1% decline recorded in the month of March. This is Canada's strongest monthly 2025 and 2026 number. It is the most growing number in at least 9 months when it comes to GDP. And this came in above all of the economists' expectations and even the commentators' expectations of Canada's economy. So at first glance, when you think about what is 0.5%, and it doesn't sound like much, but when you take a look at the big picture, such as an economy worth nearly $3 trillion, a 0.5 percentage point monthly increase represents billions of dollars in additional economic activity. So today, let's look beyond the headlines and answer the bigger question. The big question being, is Canada's economy finally turning the corner, or is it just simply a temporary rebound? This is so important to know because it depends on Canada's trajectory and what it means for 2026. We saw a war that went on for more than 3 months with US, Israel, and Iran. It took the stock prices, it increased the stock prices, and essentially when it came to affordability crisis on gas prices, it went through the roof. You had gas prices that went from $1.35 to an increasing almost $1.90. And in a very short period of time, on a daily rate, every 24 hours, you could have had at least gas prices change anywhere from 10 cents, 15 cents to 20 cents, depending what gas station you went to. So here we have it that after this months of speculation of where Canada's economy is going, as we've seen the unemployment numbers, we've looked at the provincial numbers, we've looked at the changes month on month, and here we have it. So let's understand what the GDP actually measures, right? So the gross domestic product, what GDP stands for, is the total value of everything Canada produces. So that means every car built in Ontario, every barrel of oil produced in Alberta, and every home constructed in British Columbia. So every financial transaction processed in the Toronto stock market, or every technology service provided in Waterloo, for example, and every meal served in a restaurant contributes to Canada's GDP. So think of the GDP as Canada's economic report card, if you will. So when it rises, that means businesses are generally producing more consumer goods and consumers are spending more, and companies often need more workers to be able to meet the demand on the increasing demand with supply. So when you have GDP fall consistently, what that means is there's potentially layoffs that usually follow. So when GDP shrinks for several months, like we saw in Q4 of 2025 and Q1 of 2026, that means companies are often slow to hire, they reduce investment dollars, and essentially it could also mean layoffs can also follow as well. So that is why investors businesses, governments, and the Bank of Canada watch the GDP so closely. And the reason for the Bank of Canada, they watch the GDP so closely because they make their interest rate decisions based on that as well. So what does this mean? This is an encouraging news, as it is that it wasn't going to the way we expected for the first two quarters that we saw, Q4 of 2025 and Q1 of 2026. We weren't sure that if this was going to be growth when we first looked at this number, and what does it mean when it comes to which industry has this growth. But what it's showing us upon more study, that there's at least 14 of Canada's 20 industrial sectors have expanded in the month of April. So growth has come at both sides of the economy, which is really good news. There's good producing industries, which include manufacturing, construction, mining, and energy. They grew strong at 1.2%. And meanwhile, you have Canada's much larger service sector, which represents roughly 75% of the economy, grew another 0.3%, marking its the third consecutive monthly increase. So that's essentially an important sign, because a healthy economy definitely needs both producers as well as service industries growing together. So when it comes to the energy sector, well, that is a big winner so far. The biggest contributor to April's growing number is mining, as well as quarry and oil and gas extractions, meaning it would jump 2.9 percentage points. It's the strongest monthly gain since February of 2024. So when it comes to the oil and gas production alone, it increased 3.7 percentage points. And what is the biggest reason? Well, you have Canada's oil sands rebounded sharply. When it comes to the oil sand productions, that surged 6.6% after maintenance shutdowns earlier this year temporarily reduced output. But as facilities returned to normal production, and synthetic crude oil output climbed significantly. So when you have conventional oil and natural gas production also rose 1.1%, helped by increased offshore production on Canada's Atlantic coast. And this is particularly important for provinces like Alberta, Saskatchewan, Newfoundland, and Labrador, where energy production supports hundreds of thousands of jobs and generally billions in exports. So there was one weak spot among all that, which is metal ore. Mining slipped about 0.1%, largely because facilities in northern Saskatchewan experienced maintenance shutdowns, leading to a sharp decline in production of certain specialty metals. So when it comes to manufacturing, that's another aspect of where we saw the growth return. Manufacturing also bounced back. Overall manufacturing increased about 0.6%, with durable goods leading their recovery. Machinery manufacturing jumped about 3%, helped by stronger export of industrial equipment. When it comes to wood products, that also increased 2.6%. Non-metallic mineral products, which include some cement, concrete, and construction material, rose nearly 6%, reflecting an increased building activity. And petroleum, of course, the refining of petroleum also strengthened, climbing 5.8% as exports of refined petroleum products increased. So not everything improved. When it comes to chemical manufacturing, that declined 6.8%, offsetting parts of the gains. And when it comes to manufacturing, it's remained especially important for provinces of Ontario and Quebec, where millions of Canadians either work directly in factories or depend on supply chains supporting automotive industry, aerospace industry, machinery, and industrial production. Construction, another big factor. It finally has turned a corner. Another encouraging development was in the construction sector. After falling for 4 straight months, construction industry grew 0.7%. Residential construction increased 1.3%. Much that came from renovations, home improvements, and constructions of multi-unit housing developments like apartments and condominium buildings. So when it comes to non-residential construction, that also climbed at 1.2%. Industrial buildings, including warehouses, factories, logistics centers, continued to expand on the 10th consecutive month. That's significant because construction has been under a pressure for higher interest rates that we've been going through since the end of COVID era. And the recovery here suggests that developers and businesses are slowly regaining confidence. That is a huge deal. Canada's economy has essentially grown by 0.5 percentage point in its GDP numbers for the month of April, and going through all the different sectors that have contributed to that overall number. As we're going through now, transportation, it has picked up, where you have transportation warehousing rose 0.9%. The rail transportation surged 3.8%, the strongest increase in more than a year. So why is that? Well, it's shown that more grain shipments have increased that number, and also more automotives moving through the country, as well as more exports. Now, when it comes to pipeline transportation, also increased 2.6%, with crude oil movement rebounding almost 5% after operational disruptions earlier this year. So when it comes to transportation, often acts as an economic barometer. When more products move by rail, truck, shipment, and pipelines, it usually means businesses are producing and selling more. When it comes to Canada's public sector, that also grew. It expanded by 0.4%. That includes in care, education, public administration, and the federal government administration increased for the first time in 4 months. When it comes to defense activity, that also expanded for the 7th consecutive month. Healthcare and education also recorded steady growth. Since governments employ millions of Canadians, this sector provides important stability during slower economic periods. And Canada's financial sector also grew 0.4%. Banks reported stronger deposit activity, mutual fund investments increased, and when it comes to insurance and financial services, they also continue to expand, because finance is contracted in with financial markets, it's concentrated in Toronto, Montreal, Vancouver, and Calgary, and this supports thousands of high-paying jobs in those massive cities when it comes to professional jobs. Now, the housing market, that's also showing signs of stability. One particular interesting area was when it was real estate, in these numbers shown by Statistics Canada. The real estate and rental sectors increased 0.2%, marking its third straight monthly gains. Real estate agents and brokers posted their first increases since August of 2025. With the national home resale activity improving, finally, those numbers have started to pick up. And Statistics Canada specifically highlighted stronger resale activity in the GTA. Now, while housing markets remains far below the pandemic highs that we saw took place when interest rates were down and activity was up, well, this suggests that buyers may slowly be returning as borrowing conditions have improved. Now, when it comes to employment, well, you have GDP and employment, they're closely connected. So when businesses produce more goods and services, they generally need more workers to be able to meet the demand. So now you have April's report suggests that stronger demand for workers in the sectors of energy, construction, manufacturing, transportation, finance, and public administration. That doesn't necessarily mean hiring will surge immediately, but it also means that businesses typically wait several months before expanding their payrolls. So now for stronger GDP, they often lay the groundwork for future employment growth. And what does this mean for interest rates? Well, you have the Bank of Canada that watches 3 things very closely. It watches inflation numbers, it watches employment, and overall economic growth. So when you have a stronger economy, it gives central bank more confidence that Canada is on the right track and it's avoiding a recession. So if growth accelerates too quickly and inflation begins rising again, it could also slow future interest rate cuts. For homeowners and businesses and anyone renewing a mortgage, these GDP numbers could influence monetary policy over the coming months. So what are the risks after going through all the industries that have grown during this time period? So now, despite today's positive report, there are also challenges that remain, and it's important to take a look at them. When it comes to businesses, they continue facing uncertainty when it comes to the US tariffs, as well as the ongoing CUSMA trade review. You have consumer spending that's remaining very cautious during this time. The CUSMA is the agreement between Canada, United States, and Mexico, and that is a $1.3 trillion trade agreement where you have about $3.5 billion cross the border of Canada, US every 24 hours. So when it comes to household debt, we're also looking at it's still very historically high. Global conflicts are still continuing, affecting energy markets and supply chains. That's the conflict with the Strait of Hormuz, with the ongoing tensions between US, Israel, and Iran. Even though they've signed an MOU and they're in their 60-day period for a final agreement, there's still challenges that keep erupting that could sideline the entire diplomatic dialogue that's taking place right now. So then the markets react immediately. As soon as there's signs of an escalation between any of those countries, then you have the markets essentially bringing up the price of crude oil. Immediately, you'll see an average of a 5% increase. So that all also takes into consideration, and it also affects Canada. So when you have business investments, they've also not fully recovered, having to take a look at all the different industries and what it means for so far this year. So when it comes to one strong month, it does not necessarily guarantee a long-term economic strength, which is so important to see that is this a temporary gain or is this a long-term situation where Canada is recovering after having a shrinking GDP of Q4 in 2025 and Q1 of 2026. So when it comes to recent months, Canada's labor market has remained surprisingly resilient. When it comes to employment numbers, it's continued to grow despite what we've seen in the slower economic activity. And this latest GDP report suggests that businesses may be finding enough confidence to continue hiring rather than cutting their staff. So, however, not every industry is benefiting equally when it comes to this report, as we've taken a look at all the major industries that have contributed to the GDP growth. Now, when it comes to export-oriented manufacturing, that continues to face a lot of uncertainty when it comes to tariffs, as tariffs have changed, on a quarterly basis, and times where President Trump will add a tariff on an industry, and has even said so that if CUSMA is renewed, then he would still add a tariff anyway. And then there was that 10 to 15% tariff that he said he would just do globally. So that essentially makes businesses uncertain when it comes to manufacturing in terms of whether to invest, whether to grow their businesses, and that really impacts, the impacts come from potential tariffs and the ongoing review that we're all looking to see what it means for Canada, US, and Mexico. Now, businesses generally don't like uncertainty because they have to invest their capital and they would like to get a return on their investment because businesses are for profit. So now if companies aren't sure whether the future trade will look like, then many will delay their investment dollars. They'll postpone expansion plans or wait before hiring additional workers. So that's one reason economists are watching the current Canada-US trade discussions so closely, and it doesn't look so good so far. So now another major factor is the interest rates. So over the past 2 years, we saw higher borrowing costs that slowed housing activity. It reduced business investments and encouraging consumers to spend more cautiously, save more of their money to be able to make sure that the economy is stable. Now, if Canada's economy strengthens while inflation remains under control, then you have the Bank of Canada that could continue towards a lower interest rate over time, and then you'll see a boom in activity when it comes into the real estate market. But when it comes to lower interest rates, they reduce mortgage costs, they encourage businesses to invest and make it cheaper for financing new equipment or often stimulate housing construction. So there's another side to this entire story. If economic growth accelerates too quickly and inflation begins rising again, then you have the Bank of Canada that could slow or pause future rate cuts. So that's why every GDP report matters, not just to economists, but to homeowners, businesses, and anyone with a mortgage or a loan. So let's talk about the provinces. What does it look like in each province, and how does that affect you based on where you live? So although today's report doesn't provide provincial GDP figures, we know where many of these industries are concentrated. So when it comes to Alberta, we know that is the capital. Canada has the fourth largest oil reserves, and Alberta is the capital of that. So Alberta benefits from stronger oil and gas production. Saskatchewan gains through mining and resource extraction. And when it comes to Ontario, it benefits from manufacturing, finance, transportation, and construction. When it comes to Quebec, it sees its strengths from aerospace industry, manufacturing, hydroelectric development, as well as the financial services. When it comes to BC, it benefits through construction, transportation, ports, forestry, and international trade. And Atlantic Canada also benefits when offshore energy production, as well as shipping and tourism, improves. So what does it mean for when looking ahead? Well, you have Statistics Canada that's released its preliminary estimates for the month of May, and it suggests that Canada's economy likely grew another 0.1%. Growth appears to have continued in finance and real estate. However, wholesale trade and agriculture has softened. That estimate remains preliminary, but it will be updated at the end of July. So now the bottom line is that April's GDP report is encouraging because it wasn't driven by just one lucky industry. It actually took a look at 14 out of the 20 industries. And when we saw that energy had rebounded, or manufacturing had recovered, or construction returned to growth, transportation strengthened, and when it comes to the finance industry, it also expanded. We saw real estate numbers are showing a sign of life again after quite some time of very low, below average activity. And the public service sector has continued to grow. Now, in short, you have Canada's economy appear broader and more resilient than many expected after March's decline. But the next few months will determine whether April's numbers mark the beginning of a sustained recovery or simply a temporary rebound that we're seeing for just the first month of Q2 of this year. So now when it comes to Canadians, there aren't just economic statistics. They also influence job opportunities, mortgage rates, business investments, housing prices, retirement savings, as well as ultimately the cost of living overall. And that is why every GDP report matters, not just on Bay Street or in Ottawa to take a look at, but also around the kitchen table across the country. And so while we're seeing these preliminary numbers that, estimates can change when it comes for the month of May, but they also indicate that Canada's economy may have maintained a positive momentum into its second quarter. And the biggest question now is whether this rebound can continue. While we have several risks that still remain when it comes to the trade tensions with the United States, any global economic uncertainty that could take place that we've seen with ongoing wars, 4 years into the Ukraine and Russia war, and going on to more than 3 months with the conflict with Israel, United States, and Iran. And of course, when it comes to housing affordability in the biggest markets like Vancouver or the GTA, but also household debt, that's also still a very high number, and overall business investments when it comes to their own business, when it comes to hiring, when it comes to their product line, their services, as well as if it's a manufacturing plant, when it comes to goods. Well, we're seeing that, and we're seeing that geopolitical conflicts that also continue to affect the energy markets and the supply chains. That's also another factor that the Bank of Canada always covers, as well as Statistics Canada, take a bigger picture of what is taking place and what is behind the numbers. So there's also the reasons for a lot of cautious optimism, of course. So when it comes to inflation, it has moderated significantly from the past post-pandemic highs. We saw the inflation number rise as well month by month, and that was quite alarming. But when you look at the numbers, you saw that since energy prices rose, and that contributes heavily when it comes to food prices and gas prices, well, that contributes to almost 40% of what we're seeing in the inflation numbers. And we know that that was also risen because of the geopolitical tensions in the Middle East. So here you have it, but also employment is also important to take a look at when it's remained relatively strong, as we've seen the unemployment numbers come down month by month. And another factor to take a look at is the population growth that continues to support the demand. We've seen in Canada that one of the biggest factor was that when there is mass immigration, that also somehow was able to blanket the factor of the GDP numbers in terms of Canada's growing economy. But since the numbers have reduced in terms of how many immigrants Canada takes in every quarter and every year, well, that's also exposed in terms of the productivity of Canadians. So today's GDP report shows businesses are still producing, they're still hiring and investing despite this ongoing uncertainty. And the bottom line is that Canada's economy has shown it still has resilience in it. So one strong month doesn't guarantee a boom necessarily, but it does suggest that the fears of immediate recessions have eased, which was what economists as well as everyone around the kitchen table was talking about, that Canada was in a technical recession. So now those fears have definitely eased, and now the coming months, and particularly developments around trade, interest rates, as well as business investments, will determine whether April marks the beginning of a stronger recovery or simply a temporary bounce. Since we saw the anticipated May numbers, it looks like it's on to a very slow recovery, which is also a good sign for Canadians. And it's a reminder that the economy is not just about statistics, but it really tells a story for all Canadians. We're going to take a quick break and we'll be right back.